Hello, in this session, what we'll do is we'll discuss current liabilities management. So this is the last lecture with respect to working capital management. Okay, so we'll proceed to the content now. So in terms of current liabilities management, there are two usual sources of current liabilities in businesses. The first one is spontaneous liabilities. When we talk about spontaneous liabilities, these are usually unplanned liabilities. That's why it's called spontaneous. And these are financing that arises from the normal course of business. It is not something that is planned in advance, but it's part of the day-to-day operations of a company. Meaning, these liabilities need to be incurred if you want to operate on a day-to-day basis. There are two usual types of spontaneous liabilities. One is accounts payable, another is accruals. Okay? So kung titingnan mo, spontaneous liabilities, saan ba nanggaling yung accounts payable? Comes from day-to-day operations, right? Specifically relating to inventory, and relating to the management of inventory. So yung accounts payable balances is directly linked, right, to inventory balances. So kung strong ang inventory operations or inventory stockpiling mo, wala kang magagawa. Accounts payable has to move also along with inventories. So that's why it's so spontaneous, because it's a result of business decisions or investment decisions. So you can't do much in terms of managing the gross amount, but definitely you can manage how you pay down those accounts payable. And that is the object of this lecture. Second source of spontaneous liabilities is accruals. Right? Again, you cannot simply eliminate accruals because it arises based on the day-to-day operations of a company. Right? For example, salaries are accruals, utilities are accruals. Hindi naman pwede you don't consume electricity because you want to manage accruals. Right? So the thing is, it's difficult to limit them, and they're spontaneous, so they are not planned, sources of financing. Another ambit in terms of liabilities management or current liabilities management is unsecured short-term financing. So ito na yung active na pangungutang, right? So as a company, you need to decide, do I need short-term financing so that I can bridge the gap in my cash flows, similar to how we discussed it in cash budgeting, and planado na yun. And what are the different modes of short-term financing? We'll discuss it in this lecture. Okay, what is the role of the current liabilities management in the cash conversion cycle? Of course, as you know, the cash conversion cycle is equal to days inventory plus days receivables plus minus days payable. So the role of current liabilities in the cash conversion cycle is to shorten. The longer the days payable is, the shorter the cash conversion cycle. So if you pay longer, it shortens the cash conversion cycle, which is more desirable from the point of view of the company. Okay. So obviously, there's also the concept of payment flow time. With the time it takes after the firm mails its payment until the supplier has withdrawn spendable funds from the firm's account. So similar to, we discussed float in terms of cash management. What we want to do is to collect earlier and process payments faster, because it cuts down on the collection float. Sa payment float naman, you want to make it difficult for your suppliers to receive cash, or not really difficult, but at least it will take longer for them to process your payments. Kasi the longer it takes for them to process those payments, then the longer is your payment flow time, the longer is your days payables, and the shorter is your cash conversion cycle. So that's the role, or that's the overall role of current liabilities management and working capital management. So For example, we can look at the investments in working capital. So in um, this company had an annual revenue of 4.011 billion, cost of goods sold of 1.867, and purchases of $1.3 billion. Okay. Now, based on the financial statements of the company had an average age of inventory of 206 days, average collection period of 51 days, and an average payment period of 44 days. Thus, the cash conversion cycle is 116 days. So simply days inventory plus days receivables minus days payables. Okay. Now, how much is the net funds that are stuck in working capital, because it's taking 116 days for them to convert their inventories into cash? Okay, we can sort of estimate the total amount of resources invested. Okay, so inventory, it can simply be computed as cost of goods sold times, parang kinukuha mo magkano yung cost of goods sold per day, right? And multiply it by the number of days inventory. Right? Essentially, yun yung nangyari. No? So that is 1.867 times 206 days over 365 days. So parang pwede mo rin i-interpret yan na magkano yung cost of goods sold per day times the number of days in inventory. And that's the amount of cash that is stuck in your inventory. And since it is stuck in inventory, then it's considered an investment in inventories. Now, looking at this company, if you got the AR sales per day, right, and multiply it by the average collection period, that's the amount of funds stuck in receivable. No? Ito namang payable, 1.347 billion is the amount of purchases per day times 141. Ito yung portion of your current assets that you were able to borrow. Okay? Since ito yung assets mo in working capital, and this is your borrowings with respect to working capital, so the net resources that you invested into the company is 1.93 billion. This is your equity in working capital. Yung equity in working capital na yan would have been invested in other kinds of investments. Freed up cash sana siya. But right now, it's stuck in inventory and stuck in receivables. Okay, so that's why you need to lower this and lower this so that you're able to maximize working capital, or minimize working capital, maximize excess cash. Now that could be used for investment purposes. Okay. So in terms of accounts payable, specifically accounts payable management, okay, the first thing that you need to understand is whether to take a discount or not. Okay. Ano yung iba, if you remember in AR management and receivables management, may tinatawag na cash discount. What is the cash discount? Say, for example, 210 net 30, right? There's a 2% discount if you pay within 10 days. Otherwise, you have to pay the whole amount in 30 days. That's what the cash discount means. And we looked at it from the point of view of receivables. So, ikaw ang nagbenta, ikaw ang may receivable. Now, if you are ikaw yung pinagbentahan, no, your decision is, should you take the discount or pay later? Right? So you have to weigh the costs and the benefits of early discount, right? If you pay earlier, right, you will have more investments in working capital, right? Because your investment in working capital is equal to investments in inventories plus investments in receivables less investments in AP or borrowings in AP, right? If you pay early, what happens to AP? AP becomes lower, right? And since AP becomes lower, since you're paying faster, then your investment in working capital increases. So that's the cost. No? So you have to, similar to how we analyze receivables from the receivable point of view, from the payable point of view, you also have to weigh the benefits of paying late against the cost of passing up the discount for early payment. Okay. So if if the firm chooses to give up the discount, it should pay the final day of the credit period or at the end of the grace period. Okay. So for example, if the credit terms is 210 net 30, okay, it doesn't make sense. Well, 210 net 30, you have the 10th day to pay the discount, right? It doesn't make sense for you to pay in day 11, okay, the whole amount. Kasi sana, binayaran mo na lang siya in day 10. So you want to delay as much as possible. So you want to pay on the 30th day. So yun lang yung sinasabi. It should pay on the final day of the credit period. Okay? Because you want to maximize. Ibig sabihin, mas malaki yung benefit for you of extending the accounts payable cycle, accounts payable days rather than obtaining the 2% discount. So you should maximize it to the extent possible, which is to pay at the end of the credit period. Okay. Now, the cost of giving up an early payment discount is the implied rate of interest paid to delay payment of an accounts payable for an additional number of days. Okay. So that is the cost of giving up an early payment discount. Let's look at this example. Okay. So the company purchased $1,000 worth of merchandise on February 27 from a supplier extending terms to 10 net 30. Okay, to pay in 30 days, which is the end of the month. Okay, if the firm takes the discount, it must pay 980, which is 1,000 times the discount minus the discount. Okay, by March 10th. Thereby, you are saving $20. So if the company gives up the discount, it can pay on March 30, it will pay $1,000. Okay, so obviously there's a trade-off here. Okay, what is the trade-off? The discount of $20, no, and the time between March 10 and March 30. Your cash could earn money between March 10 and March 30, and that opportunity to invest your cash might be more than 2%, right? And so therefore, that's the decision that you need to analyze. To keep its money for an extra 20 days, the firm must pay an extra 20 essentially, or 1,000 rather than 980. In other words, if the firm pays on March 30, it will pay 980, what it could have paid on March 10, plus a $20 interest. So kaya kung isipin mo, yung foregoing the discount, para kang nangutang doon sa pinagbilhan mo ng inventories, right? Because your principal essentially is 980, your interest essentially is 20, right? And that interest of 20 arises if you forego the discount. Okay? So that's why essentially giving up credit terms is tantamount to borrowing from your suppliers. Okay? So that is an important concept because more and more industries are relying on what's called supplier financing, or sometimes this is called supply chain financing. Okay, you have a case on supply chain financing so that you will look at these concepts. Okay, so yung supply chain financing essentially ito yung provision of discount. Kung ikaw yung seller ng merchandise, when you offer a discount, if essentially you're giving your customer an opportunity to borrow from you, no? And it is in the form of foregoing the discount or not. Okay. So to calculate the implied interest rate associated with giving up the discount, we simply treat 980 as the loan principal and 20 as the interest. No? So if the interest is 20, principal 980. So you have an implied interest there of 2.04%. And that 2.40% is what? That is the cost of a 20-day loan. Why is it the cost of a 20-day loan? Let's look at this illustration. Okay. The firm makes 1,000 purchase, Feb 27. The credit period begins on March 1. You have to pay on May 10. So essentially, yung 980 should have been paid, no, in March 10, but you're paying 1,000 by March 30. So in any case, the $20 arose because you're paying 20 days later, right? So the 2.04% is actually the cost of a 20-day loan, okay? So the gross amounts looks low in percentage terms. It's 2.04%, but actually 2.04%, that's the interest of a 20-day loan. We don't know whether that's very expensive or not, right? You have to have a way, to determine whether that interest rate is uh, uh, comparable with other interest rates. Okay? So you have to keep in mind that the 2.04 that we calculated here applies to a 20-day loan. So you need to get what's called the annualized interest so that you can compare it with other types of loans. We'll discuss more of that later. Okay. Now, what is the implied cost of giving up a discount? So the general expression of calculating the annual percentage cost of giving up a discount is given by this formula. Okay. CD over 100% minus CD times 365 over N. CD is the cash discount in percentage terms. So in our case, that's 2% over 100% minus 2%. So that's this portion. Okay. Times 365 over N. And N is the number of days that payment can be delayed by giving up the discount. In our case, the credit terms was 210 net 30. You have to pay on the 10th day, otherwise pay on the 30th day. So this period is 20 days. Okay, so that's why it's 365 divided by 20. Now, and when you determine the annualized cost of giving up the discount, it is 37.24%. So yung 2% na loan that is 20 days ang tenor is equivalent to an annual loan with a cost of 37.24%. So it's expensive, right? It's a very expensive loan. No? And so therefore, baka bayaran mo na lang yung 980 rather than pay 1,000. No? Kasi yung $20 na yan, mukhang kaunti lang, right? But on an annualized basis, that interest rate is actually 37%. That is a very expensive loan, right? And so that's something that should be considered in your analysis. So usually credit discounts are very expensive if you do not take them, no? If you give them up. So you have to check also, right? So how do you use the cost of giving up an early payment discount in decision making? So the financial manager must determine whether it is advisable to take a discount. So when a firm can obtain financing from a bank or other institution at a lower cost than the implicit interest rate offered by the suppliers, the firm is better off borrowing from the bank and taking the discount, no, offered by the supplier. Okay? So yung atin kanina is ano ang cost nun? 37.24%, right? That is the cost of giving up the discount. And then, if for example, you can get a similar financing or financing from a bank, say at 10%, So, utangin mo na lang yung 980 at 10% para makabayad ka before the discount period ends. Rather than forego the discount and pay later because it costs you 37.24% of interest to wait for 20 days. So I guess that's the interpretation of these statements. So let's have this example. A company has 4 possible suppliers, each offering different credit terms. Okay. Otherwise, their products are identical. So the table below presents the credit terms offered by suppliers A, B, C, and D, and the cost of giving discounts in each transaction based on the approximation method that we discussed. Okay. So the cost of giving up the discount for each of the suppliers are like so. So let's try to simulate this. For the first one, okay, 210 net 30, no? So that's 2 over 2% over 100. 2% over 100% minus 2% times this period is 20 days, right? So that's 365 over 20. Okay. So naman, that is 1%, right? So that's 1% over 100% minus 99. 100% minus 1% times 365 divided by how much is this credit period from 10 days to 85 days, if essentially 75 days. So that's how this cost of giving up a discount is, okay, provided, and so on and so forth for the others. So from here, what is the conclusion? The conclusion is supplier B has the least cost of giving up a discount. So if you choose supplier B, for example, it might be the case that it's best to just forego the discount rather than borrow in a bank and pay off the obligations. Okay. So another kind of spontaneous financing is accruals. Okay, so accruals are liabilities for services received for which payment has yet to be made. So you know this already as wages, taxes, utilities. No, so firms have very little flexibility in manipulating the timing of payments made to the government and even to some utilities kasi puputulan ka ng services. So you also need to prioritize which ones are worth paying late. No, kasi baka iba is too crucial for you to actually, it will disrupt operations kung hindi sila bayaran on time. Okay? Firms can manipulate accrual of wages to some extent by delaying payments of wages and by receiving interest-free loan from employees. However, of course, it will impact the well-being of employees, their loyalty, pwede magka-organizational issues. So you also need to choose your battles, I guess, no? So an example, the company currently pays its employees at the end of each work week. The weekly payroll totals $400,000. If the firm were to extend the pay period by paying its employees 1 week later throughout an entire year, the employees would in effect be lending $400,000 for a year. If the firm could earn 10% annually on investment funds, such strategy would be worth $40,000 per year. No, in effect, parang nagpautang nga yung employees to the company kasi natanggap na sila dapat, no, at the end of the work week. Pero dahil na-delay ng 1 more week, there's an opportunity cost there, right? The 1 week. And that could provide some windfall to the company. Okay. Now, In terms of unsecured sources of financing, so businesses usually obtain unsecured short-term loans from two major sources, banks and the sales of commercial papers. So bank loan, for example, are short-term self-liquidating loans. So an unsecured short-term loan in which the use to which the borrowed money is put provides the mechanism through which the loan is repaid. These loans are intended to mainly carry the firm through seasonal peaks in financing and needs that are due primarily to build-ups of inventory and accounts receivable. As the firm converts inventories and receivables to cash, it generates the funds needed to retire these loans. So for example, if you look at our exercises, for example, in cash budgeting, right? There are really seasonal operations in such a way na malaki lang talaga yung working capital requirement ng kumpanya in certain months because of adjustments to the seasonality of sales, for example. But you know, and you can see in your cash budget that it is self-liquidating. What does it mean? Pag na-collecta mo na after the peak season, you have so much excess cash naman. And that excess cash you can use to liquidate the loan. So that's why we know that those kinds of loans are self-liquidating. Because we know that we're only bridging a timing issue in terms of cash flows. Talagang meron lang talagang build-up of inventory before the peak of a season. And therefore, dahil may build-up of inventory, there's a lot of financing needs. Because of that, kailangan umutang. Kailangan magkaroon ng short-term financing. Pero very evident din naman ng reversal fortunes, right? Because after the peak season, you have so much excess cash. And those excess cash will be used to pay down debt. That's why we say that usually short-term financing with unsecured sources are self-liquidating loans. And banks will really look into the cash flow forecast of the company. Now, for bank loans, of course, loans have a cost. So if that cost is in the form of interest. Interest can be fixed or floating rate loans. So a fixed rate loan is a loan with a rate of interest that is determined at a set increment above the prime rate or what's usually called in the Philippines as the benchmark rate, or sometimes called reference rates. Those are all equal to this one. And remains unvarying until maturity. The key is it's a fixed rate and it is unvarying. Okay, so for example, January 1, 2021, nangutang ka at 7%. And that loan is to be paid by December 31, 2023. That loan, if it is a fixed rate interest, will still pay 7% interest all throughout. A floating rate loan, on the other hand, initially set at a rate and then it varies until its maturity. Okay? So usually, sinasabi how many percentage points above a benchmark rate. And then sinasabi rin yung tinatawag na repricing dates. Meaning repricing, kailan mapapalitan yung interest rate ng loan. Kasi nga, floating loan. By floating, it varies until maturity of the loan. Okay? So, for example, nangutang ka ng January 1, 2021, okay? At ang rate is 2% above the reference rate. Okay? Ang sabi sa loan is that by December 31, 2022, you will reprice on that date. Paano ang repricing? Ganun din, 2% above the reference rate. Assuming the reference rates are 7% noong January 1, 2021, and 8% ng December 31 of 2022, okay? December 1, 2021 yan, 2021, what will be the applicable interest rates? The applicable interest rate is from January 1, 2021 to December 31, 2021. The applicable interest rate is 7% plus 2%, which is 9%. Kasi 2% above the reference rate, and your reference rate is January is 7%. Ngayon, pagdating ng December 31, 2021, until the next December 31, 2022, the new interest rate will be the new reference rate, 8%, okay, plus the margin, which is 2%. So it will be 10%. So yun ang ibig sabihin ng floating interest rate. Okay. So in the Philippines, the reference rate is called BVAL, BVAL reference rates. So Bloomberg's BVAL pricing for government securities is the benchmark reference rates accepted by the Bankers Association of the Philippines. So the Bankers Association already decided that they'll use this as the reference rates. Okay. Now, TAP, the Bankers Association is the benchmark administrator and the owner of the BVAL reference rates. Okay. So if you look at this, ito yung reference rates kahapon, I think. No? So that's November. So today is November 24. So November 23. Now this was the reference rates in November 23. Okay. So kung ang utang mo is ang tenor is 1 month, meaning 1 month lang yung duration ng loan, the reference rate is 1.0883%. Ngayon, this is the reference rate, dadagdagan mo pa yan ng margin. Yun yung dinagdag kong 2% kanina in the earlier example. Okay. So for example, the loan is for 1 year. The reference rate is 1.6502. So, ganon, 1.6502 plus the margin ko kanina. So the interest rate is 3.6502%. So that will be the applicable interest rate for my loan. Okay? Sige. So how do you calculate the interest of a loan? No? So if the interest is due at maturity, the effective annual rate and the actual rate of the interest paid for a 1-year loan is equal to interest over amount borrowed. So remember, maraming assumption to. Okay. It should be a 1-year loan, and it should be the interest is due at maturity. Okay. So kung nangutang ka today, or nangutang ka ng January 1, 2021, the maturity date is December 31, 2021. Okay. You have to pay the principal and interest on the same dates. So you receive principal January 1, 2021, and then you pay the principal and the interest December 31, 2021. Now, how do you compute the interest rate? So that's the amount of interest over the amount borrowed. Okay, very simple. Okay, now, sometimes there are loans where the borrower pays the interest in advance. Okay. In that case, the bank deducts the interest payment from the loan principal so that the borrower actually receives less money than the loan's face value. Okay? So, tawag doon, discounted notes or discounted loans. So, kahit na, for example, nangungutang ka ng 10 million, tapos ang interest, for example, is, nangutang ka ng 10 million. Okay? The interest is 1 million, for example. If it is discounted, meaning i-deduct yung interest at the onset, ang matatanggap mo na lang net proceeds out of the loan will be 9 million. Okay? So, ganun yung itsura niya. So, in this case, loans na ganito, how do you compute for the loan interest rate? It's interest rate in the numerator divided by the amount borrowed minus interest rate. Okay, so that's the effective annual rate for a 1-year discount loan. Okay, this is how you compute the loan interest rate. Okay, let's have some examples. So the company is a manufacturer and wants to borrow $10,000 for 1 year at a stated annual interest rate of 10%. If Wooster pays the interest of the loan at maturity, the firm will pay 1,000 plus 10,000, which is the principal. So at the end of the year, Wooster will write a check to the lender for 11,000, 10,000 for the principal, 1,000 for the interest, consisting of 1,000 interest as well as the principal. When you substitute it, what is the effective interest rate? No, it's 1,000 is the interest over the amount borrowed. It is 10%. Okay. However, if Wooster borrows the money at the same rate 10%, okay, but it pays the interest in advance, okay, the firm still pays 1,000 interest, but it receives only 9,000. Dito kasi yung received funds mo, sa first one, the received funds is $10,000. Here, what you receive is actually $9,000 only, right? The denominator, that is the amount that you actually receive. So that's 10,000 minus 1,000 kasi 9,000 lang naman talaga yung na-receive mo. Right? But you ended up paying 1,000 interest anyway. So therefore, yung interest rates ng first example saka ng second example are not the same. Because in the first example, you paid interest of $1,000, you received funds of $10,000. Pero ito, you paid the same amount of interest, but you only received 9,000. So obviously, you should have a higher interest rate. Okay. Now, we compute. So that's 1,000 divided by amount borrowed, 10,000 minus 1,000. That's interest that has been deducted in advance. Okay, so that's 1,000 over 9,000. That's 11.1%. That is the effective interest rate. Okay. Ano pinagkaiba nila? Pinagkaiba nila is that the interest was deducted in advance in the second example, right? And that made a difference in the effective annual interest rate. So we now go and discuss the different types of unsecured sources of financing. Okay, one is the single payment note. So it's a short-term, one-time loan made to a borrower who needs funds for a specific purpose for a short period. This type of short-term note generally has a maturity of 30 days to 9 months or more, usually short-term in nature. The interest charge is usually tied in some way to the prime rate or another benchmark interest rates. So let's have an example. The company recently borrowed $100,000 from two banks. Okay. The loans were incurred on the same day when the prime interest rate was 4.25%. Each loan involved a 90-day note with interest due in 90 days. Okay. So this is today times 0. After 90 days, both the principal and the interest are going to be paid after 90 days. The interest rate was set up 1.5% above the prime rate on Bank A's fixed interest loan. Over the 90-day period, the rate of interest of this note will of course remain at 5.75%. Saan galing yun? The prime rate of 4.25 plus the credit spread of 1.5%. So that is 5.75%. So how much is the total interest of this loan? So that is 100,000 times 5.75% is the interest rate times 90 over 365 because 90 days lang naman. Remember, interest is principal times rate times time, right? The principal is 100,000. The rate is 5.75%. This rate is an annual rate. And so yung time mo is as a fraction of 1 year. So that's 90 days over 1 year. Okay? And that amount is 1.417.81. Okay? Which means that the 90-day rate of this loan is about how many percent? The amount of interest that you paid, 1.417.81%. 1.81, right? Divided by the amount that you received. How much did you receive? You received 100,000. That is the amount that you loaned. So therefore, the rate is 1.42%. So 1.42% is the 90-day rate for this loan. Okay. You own 5.75. This is the annual rate for the loan. Okay. Remember, interest rates are defined by the period wherein they are applicable. Okay. So therefore, yung 1.42% is valid for a 90-day loan. And the period is from 0 times 0 to time 90. So ang interest dito, 1.42%. However, kung i-roll over ko yan ng several other 90 days, right, meron yung equivalent na interest rate na pang annual interest rate. And that's the effective annual rate. Okay? Try to discuss that further. So assuming that the loan from Bank A is rolled over each 90 days throughout the year under the same terms and circumstances, we can find its effective annual interest rate. Okay? So the 1.42%, again, the 1.42% is the 90-day interest rate. Okay? And since mangyayari siya every 90 days, kung ulit-ulitin mo yung loan na yan, every 90 days, okay, then makakakuha ka ng equivalent niya na full year. Right? At yung full year na interest rate para sa buong taon, yun yung tinatawag na effective annual interest rate. How do you compute for it? The effective annual interest rate is equal to 1 plus the interest rate, okay, times, so for example, an interest rate here is defined by number of days, n. Okay. The exponent is 365 divided by n, which is the number of days for which this interest rate is applicable, minus 1. Okay. In this case, that is 1 plus 1.42% raised to 4.06. Saan galing yung 4.06 dito? 365 days divided by 90 kasi this interest rate is valid for a 90-day period, minus 1. And that's how you get 5.89% here. That is the effective annual rate. So let's look at a different example. For example, Bank B naman. So Bank B set the interest rate at 1% above the prime rate, and its floating rate. Note, the rate charged over 90 days will vary depending on the prime rate every 30 days. Okay. Initially, the rate will be 5.25, but when the prime rate changes, so will the interest rate change on the loan. For instance, if after 30 days, the prime rate rises to 4.5%, and after another 30 days, it drops back to 4.35%, the firm will be paying how many? No, 0.432% for the first 30 days, which is essentially 5.25, which is the annual rate, times 30 divided by 365. 0.452 for the next 30 days, 5.5 times 30 divided by 365. And 0.432 for the last 30 days. If you compute that, okay, the total interest that you have to pay is 1.315. So $1,315 divided by $100,000. So therefore, your 90-day rate is 1.32%. Again, this is the 90-day rate. You can convert it to an effective annual rate, right? Now, how much is the effective annual rate? So, assuming that the loan is rolled over 90 days, the effective annual rate is 5.47. So, that is 1 plus the interest rate, 1.32% raised to Saan nga nakuha yung 4.06? That's 365 divided by 90 days. Okay, minus 1. So that's 5.47%. So clearly, in this case, the floating rate loan is less expensive because 5.8 yung kanina, di ba? Yung Bank A. So Bank B is definitely the cheaper source of financing. So another thing that we need to discuss is the line of credit. So you have heard it from our classes from time to time. But what really is a line of credit? It's an agreement between the commercial bank and the business specifying the amount of unsecured short-term borrowing the bank will make available to the firm over a given period. Para siyang kitty na saan. Line of credit is an agreement between the business and the bank. For example, apply ng line of credit ng 2 million sa kliyente ng banko. Ano ibig sabihin ng line of credit ng 2 million? Mayroong nakaatang na pera na 2 million para sa kumpanya. Okay. And the client can apply for that 2 million and get that cash anytime that it needs. Okay? Para siyang savings, pero in the form of a loan. Para siyang credit card. No? Para siyang credit card. Because in a credit card, may limit ka, di ba? Kasi 1 million limit. 1 million ang limit mo, basta anytime pwede kang maghiram up to 1 million. Pwede mo ring bayaran anytime. Right? Okay. So that's what a line of credit is. It's like a credit card for a business. Okay, and that's how it works. So, kung kailangan mo, punta ka sa bangko, mangutang ka under the line of credit. Okay. Interest rate on the line of credit is normally a floating rate. That's the norm. Contractual restrictions that the bank will impose on the firm's financial condition or operations as part of the line of credit. Siyempre, nag 5 C's of credit sa'yo ng banko. Kaya ka na-approval ng line of credit. So therefore, there are significant changes on the 5 C's. Nagbago ang character, nagbago ang collateral, nagbago ang cash flows. Then they may withdraw. So they may withhold the line of credit. Right? So hindi siya guaranteed. Yun naman yung isang factor ng line of credit. Sa credit card, guaranteed. You can always borrow as long as you're within the limit. Here, there's an operating change restriction. So if there are significant changes to your credit standing, hindi ka makakakuha under the previously approved. Usually, line of credits require compensating balance. It's a required checking account balance equal to a certain percentage of the amount borrowed from the bank under a line of credit. So compensating balance is cash na hindi mo magalaw, right? Because you have to maintain it with the bank. As a condition to the provision of line of credit. And usually there's an annual cleanup requirement. So annual cleanup is a requirement that for a certain number of days during the year, the borrowers under a line of credit carry a zero loan balance. So, pwedeng say 10 days in a year, zero balance yan. Right? So you have to find ways to manage financing. There are annual cleanup provisions. Example. So a company has borrowed 1 million under line of credit agreement. It must pay a stated interest rate of 8% and maintain in its checking account a compensating balance equal to 20% of the amount, which in this case is 200,000. Actually receives the use of only 800,000. So I think that's very familiar to you. Okay. Even though he borrowed 1 million, pero dahil may required compensating balance of 200,000, in effect, ang nakuha lang talaga niya, 800,000. So what is the impact of a compensating balance? It reduces the amount that you really receive as a result of the loan. And because the amount that you receive is smaller than what you intended, right, then tumataas yung cost of the financing. Similar to the deduction of interest. Right? So in effect, ang denominator mo, ang kuha ng effective interest rate is only 800,000. Because that's the amount that you receive out of the loan. Okay. Even though you will be paying 1 million times 8%, which is what? 80,000, right? 80,000. So the effective annual rate here is 80,000 over 800,000, which is 10%, which is 2% more than the stated rate of 8%. So here, what's the rule now? It's evolving. Interest over principal minus the compensating balance. Kasi it reduces the amount that you can utilize. If the firm normally maintains a balance of 200,000 to the bank, meron silang relationship, and talaga namang nag-maintain siya ng 200,000 doon, regardless. Okay? If that's the case, then you actually will receive the entire 1 million, right? Kasi may account na talaga ng 200,000 before the loan. And so wala nang maiipit na pera sa compensating balance. Kasi normal mo cash balance of 200,000. In that case, the effective rate is equal to the stated rate of 8%. Because yung 80,000 numerator, ang denominator niya, 1 million na. Right? Kasi yung compensating balance in this case is 0. Kasi meron ka ng 200,000 na checking account in the first place. However, if 100,000 lang yung checking account, kailangan mo pang magdagdag ng additional 100,000 na hindi mo usually gagawin. Meaning, this 100,000 is additional tied up funds. Right? And so therefore, it will reduce the denominator. It becomes 80,000 divided by 1 million minus 100,000. So 80,000 divided by 900. So that's an effective interest rate of 8.89%. Okay, so thus, a compensating balance raises the cost of borrowing only if it is larger than the firm's normal or regular cash balance. Now, another term that you will see frequently in working capital management or short-term financing is a revolving credit agreement. It's the same as a line of credit. The only difference is a revolving credit agreement is a guaranteed line of credit. Okay? Bawal tanggihan ng bangko pag kukuha ka na ng pera under a guaranteed line of credit. Pero since guaranteed na yung line of credit, hindi naman pwedeng walang kinita yung bangko. Okay? You will have to pay what's called a commitment fee. Okay? Committed yung bank na nagbigay sa'yo ng pera, pinagaranti niya na magbibigay siya ng pera under any circumstances. Okay? Provided you pay me a commitment fee. I'm the bank. Okay? You pay me a commitment fee. So the fee that is normally charged in a revolving credit agreement is called a commitment fee. And since you're buying a commitment fee, I am committed to provide you funding. Okay? It often applies to the average unused portion of a borrower's credit. Kasi kung unused yung credit line, it means hindi kumikita ng interest yun. So dapat i-provide it. Okay. Example, the company has a 2 million revolving credit. Its average borrowing under the agreement for the past year was 1.5 million. The bank charges a commitment fee of 0.5% of the average unused balance. Because the average unused portion of the committed funds was 500,000, which is 2 million minus 1.5 million, yun yung portion na applicable yung committed fee. Right? Kasi ang average utilization is 1.5 million, the size of the revolving credit agreement is 2 million, so yung difference yan, 500,000, it means that is not used, the unused portion. So yan, meron yung commitment fee na kailangan pang bayaran. So that's 5%, 0.5% times 500,000, so 2.5. Okay. Of course, the company also needs to pay interest na 1.5 million on the actual 1.5 million. The assuming that the interest rate, the interest is 100 to 500. So therefore, how much is the effective interest rate? The effective interest rate is 112,500, which is the interest. You also pay commitment fees up to 5 divided by the amount that you actually receive, which is 1.5. So this is equal to 7.67%. So that is the effective interest rate of the loan. Okay. So what you need to understand here is what is the numerator? The numerator is interest, okay, minus plus sorry, as commitment fees over the used portion of the revolving credit. Okay? The denominator is not 2 million, right? Hindi mo naman ginamit yung 2 million sa revolving credit agreement. Ginamit mo lang 1.5. So that's a denominator. So what are commercial papers? Commercial papers are a form of financing consisting of short-term unsecured promissory loans issued by firms with a high credit rating. So outright utang ng companies. So commercial papers usually sell at a discount from its par value or face value. And the difference between the amount that you received and the face value, that's the interest. Okay. So for example, a company has just issued 1 million worth of commercial papers that has a 90-day maturity, which sells for 995. So the amount that you receive is 995,000. But at maturity, you're going to pay 1 million, right? So in effect, there's a 5,000 interest. So that's 5,000. Okay. So therefore, the 90-day loan costs you 0.502%. Okay, you can try to annualize that. When you annualize that, using the formula, it becomes 2.054%. Now, what I discussed are the unsecured sources of financing. Of course, there could also be secured sources of financing. Ano ibig sabihin ng secured? Merong collateral. That is the only mean change between an unsecured and a secured source of financing. So a secured source of financing is a financing that has a specific asset pledged as collateral. That specific asset can be, for example, receivables, inventories, even properties. You know? And it is usually governed that the securitization or the pledging of those assets as collateral are embodied in a security agreement. So the agreement between the borrower and the lender that specifies the collateral held against a secured loan. Okay. What are the characteristics of secured loans? Secured loans usually have a percentage advance, a percentage of the book value of the collateral that constitutes the principal of a secured loan. So for example, nag-humingi ka ng loan na secured, okay, or nag-apply ka ng loan na secured from a bank. At ang gusto mong i-pledge is your inventories, and your inventories is worth 2 million pesos. Obviously, the bank will not provide you a loan worth 2 million pesos. Why? The bank is not even sure if your inventory will really sell for 2 million pesos. That's number one. Number two, it's not sure whether it can sell the inventory in the first place. If walang takers, right? So there are risks related to your collateral. So sila, maninigurado sila, right? So therefore, papautangin ka nila only as a percentage or only equivalent to a portion of the amount that you collateralize. Okay? So it could be as low as 30%, or it could be as high as 50% or 80%. Very rare that you'll see 100% of the book value of the collateral, unless it's a very liquid asset that you are putting up as collateral. Otherwise, there will always be a discount factor. Okay. The primary sources of secured short-term loans are, of course, commercial banks and commercial finance companies. So one frequent way of, one possible way of putting up financing is to use receivables as collateral. It's called receivable financing. Okay? So you can use a firm's accounts receivable as security or a collateral to obtain a short-term loan. So here's the pledging process. So when a firm requests a loan against accounts receivable, the lender first evaluates the firm's accounts and receivable to determine the desirability as collateral. Of course, they'll do their due diligence. Right? Titingnan nila, alin dito ang trustworthy accounts. At yun lang ang pipiliin nila. They will select only acceptable amounts. Okay? And then, mag-adjust na tayo ng dollar value of those accounts. Okay? So the lender evaluates the quality of the acceptable receivables and their costs of liquidation. And then they'll apply a percentage na yun lang ang amount that they will loan. So pag nalinis na nila, ito yung acceptable accounts, ito ang acceptable AR balances, na total ko 2 million. Pero hindi kita pautangin ng 2 million. Papautangin ko sa lang sa'yo is somewhere between 50 to 90% of the face value. Because it could be the case that they won't pay, right? And so therefore, the bank has to be protected in that way. Okay? Pledging of accounts receivables could be on a non-notification or notification basis. If it's non-notification, the basis on which a borrower continues to collect the account payments without notifying the account customer. So hindi alam ni customer na naka-pledge ang accounts niya. Kasi nagbabayad pa rin siya to the borrower, which is to businesses na pinagbilhan ng goods and services ng customer. So that's a non-notification pledging of accounts receivable. If it's notification basis, yung customers are informed that you have to pay the bank. Okay, so the payment should be remitted directly to the lender. Pledging cost. The stated cost of a pledge is normally 1% to 4% above the prime rate. The addition of the stated interest rate, there could be service charges, which would be as high as 3%. Another is to factor receivables right away. Yung pledging is parang iniintay mo pang makolekta yung mga receivables. And once collected, it is applied against the loan. Yung factoring is an outright sale of the accounts receivable. Parang gusto mo sabihin sa bangko, sa'yo na yung receivables ko, no? Then bigyan mo na ako ng pera that is equivalent to the amount of receivables that I have. Okay? The terms are usually embodied in a factoring agreement, and the factor is the institution that specializes in purchasing AR. Okay? And factoring is usually on a non-recourse basis. Okay? Ano ibig sabihin nun is that the factor accepts all credit risks related to the receivables. So then, syempre, gagawa siya ng due diligence to make sure that makonsider niya yung mga non-payment of accounts. Okay? What are some factoring costs or costs related to factoring? So that's commissions, interests, and other administrative costs. Okay? Inventories can also be used as collateral. Okay? So inventory is generally second to AR because it's more difficult to sell inventory rather than collect receivables. Okay? So the most important characteristic of inventory being evaluated as loan collateral is marketability, obviously, meaning ability to sell, right? So if it is an inventory that is easily spoiled, that won't be acceptable as collateral, right? Kasi mabubulok, wala ng value pag nabulok, right? So therefore, they prefer inventories that have a longer shelf life or something that ages well, you know? So those are inventories that may be put up as collateral. Usually, there's floating inventory liens. So secured short-term loan against inventory under which the lender's claim is on the borrower's inventory in general. Because it's difficult for a lender to verify the presence of inventory, the lender generally advances less than 50% of the book value of inventory. Okay? And the interest on that is 3 to 5% above the prime rate. Okay? So what I'm just saying is that receivables and inventories can be used to be put up as collateral to enhance the ability of the company to obtain short-term financing. Okay, that's it. Thank you.